When markets act in unexpected ways, it challenges even the best of investors to stick to their process. And of course, sticking to your process in part is knowing thyself. This week, we're going to explore the two predominant types of investors that are out there, help you identify which one you may be, and the challenges to keep in mind during times like this. So as we touched on in the intro, this has been a crazy week of market movements, really a crazy month. And again, it's far more emotional than factual. We're going to get into that in a moment and talk about the fears, one of two, that play on all of us as investors and challenge us to be overcome, to be successful. The last 2 days are really a perfect example of how the markets in a short-term basis are far more like musical chairs, which is an analogy I've used before, than something that makes a whole lot of sense. With everybody wondering, is this the next leg down if you're a losing money mindset, or is it the next leg up, I got to get in if you're a fear of missing out mindset? It's not fundamental. There's nothing that changed that big in the world between Wednesday's sell-off, where there's red on the screen and scary headlines, only to wake up Thursday morning of this week to see tons of green on the screen. In fact, even Microsoft after hours last night, just to use a little example, initially dropped 4% on some great news, only within 10 minutes to be up 6% from that low to finish up 2% in the after hours market. Again, that's emotions. That's not fundamental analysis. And it's the kinds of thing we hope we can all avoid. Today, we're going to look at who are you as an investor? And what we're going to talk about predominantly is what type of fear resonates most with you. Like the money mind exercises we walk through with clients to understand who they are from a planning concept. People can relate to both, but usually one of them is a dominant investment mind, in this case, a dominant fear that they have that drives their investment making decisions. So what are they? We'll walk through this chart. But again, the root, like many things, comes in fear. For some, it's a fear of missing out. It just drives them crazy when they see something going up, up, and away, and they don't have any of it. Conversely, for others, it's a fear of losing money. They've worked so hard to have what they have, and the idea of one of those dollars disappearing even for a moment keeps them up at night. What are some of the characteristics of these two people? Well, for the fears of missing out, these are people who tend to focus on and be tempted by performance. They're the performance chasers, if you will. When that cocktail party stock tip starts making its way around the room, their ears perk up. When they read the great headlines about a Bitcoin or a FANG stock, they hurts them that they don't have any of that perhaps in their portfolio. For the characteristics around losing money, of course, these are the people who headline news, sudden drops in the stock market, keep them up at night. They tend to be quick to engage in a slippery slope type of logic that whether it's the bird flu or a 2% drop in the stock market, this is the beginning of something much, much worse. And they go down and down and down until they get worked up into quite a state of fear. Some realities to understand. Number one is we're all one of these to some extent. It's not good or bad. It certainly can be overcome. But one of the things to help do that and to understand, again, not to feel too bad about which one you may be, or conversely, not feel too good or think that there is one that's the best way to go through, are the challenges that exist for either type of investor. For those people who are a fear of missing out type of investor, they need to understand they're always going to miss out on something. It's just not plausible that you're always going to have the hottest stock, the hottest crypto, the hottest asset class, and trying to chase whatever has been the hot thing can work for a moment. You might be able to ride a little bit of that momentum for a bit longer, but statistically, over time, it's why so many people fail to keep up with the long-term averages of most investors. For those people who their fear is of losing money, they need to understand that there's a very big difference between volatility and risk. Risk is a permanent impairment of capital. Volatility are the short-term or perhaps even intermediate-term fluctuations in value. And they're different, assuming, again, you've built a plan that can give you time to get through them. The other thing we see with respect to the losing money mindsets is two things I want to focus on again, since this is where most people are. Number one is just an understanding of market history. Very few 5% drops statistically become 10% declines. Only about 20% of declines become full 20% drops. In fact, most 20% drops outside of Black Monday don't happen without a recession. So again, every little drop in the market, this is the beginning of the next big crash. That's how we react on a gut level. We need to try to engage, again, that knowledge of history to understand from a probability perspective, it happens very, very few times. The other key thing that I see with the people who try to avoid losing money even for a moment is that they take on more long-term risk than they mean to by trying to avoid some short-term volatility. And here's what I mean by that. Yes, you can buy an annuity with a certain guaranteed rate of return, or you can hold cash, but very, very few of those investments or opportunities are going to even keep up with a long-term rate of inflation. And at the end of the day, the reason we're all saving, the reason we're investing to grow our assets is with the hope to be able to take care of our needs and maybe even enjoy some of our wants later in life. And if you're eroding your purchasing power over time, that's not likely to happen. Both mindsets think they can time the market. I think that's the other important thing to keep in mind, which isn't true. For the fear of missing out people, they think that, yeah, it's gone up, but it's going to keep going up, and I'm going to ride that last realm and get out. For the people who are losing, again, they're just sure that it's the beginning of a bigger thing, and they'll get back in at the bottom. In my experience, it's really hard to sell something that's been going up, and away. Most people will write it back down unless they've got, again, a process of buying and selling and rebalancing. And for the losing money people, and I saw this again quite a bit in 2008, 2009, they're always waiting for the next shoe to drop. Oh, this is a head fake. Oh, it's going to keep going down. And that get back in part to the market proves a lot harder than the getting out of the market proved to be. How does diversification play into this? And the thing, well, number one, when we're talking realities, it's understanding that for every amount of risk that you take, you should be getting a commensurate amount of return. And just because you take a ton of risk, missing out crowd, doesn't mean you're going to get paid. And that's this red danger zone here where we're taking a risk and not getting up to this efficient frontier line of maximizing the return we're getting for the risk we're taking. These are all the people who are buying Powerball tickets down here. Lots of risk, very little, if any, return. Conversely, there can be moments in time, think Bitcoin at the end of last year, or the FANG stocks for the last couple years, where things can just be going up and away, and people can be lulled into by a lack of short-term volatility from understanding how much risk they're really taking to get those returns. Over time, this is gravity. Everybody mean reverts here. And again, the role of that diversified portfolio for the missing out crowd is you're always going to get to have something that hopefully is doing well and you can take some pride in. And for those afraid of losing money, again, that diversification is going to act as a buffer to that volatility. So hopefully you have a little bit of emotional fortitude left in the tank for when those really, really trying times come along. With that, we're all one of the two. Which one are you? And understand those challenges that need to be overcome to successfully invest over time. Thanks so much.